What is inheritance tax on farmland? Have you ever wondered how inheritance tax applies to farmland? This topic is essential for anyone involved in estate planning, especially if you have agricultural property. Inheritance tax on farmland refers to the federal estate tax that may be applied to the value of farmland passed down from a deceased person to their heirs. This tax is part of the overall estate tax system, which includes all assets in the estate, such as farmland, equipment, and other properties. The tax is calculated on the total value of the estate that exceeds the federal exemption threshold. As of 2024, this threshold is over $13 million, and it is adjusted for inflation. If the estate's value is below this amount, no federal estate tax is due. Now, let's talk about how farmland is valued for estate tax purposes. Farmland can be valued differently than other types of property. Instead of using the fair market value, which can be quite high, the Internal Revenue Code Section 2032A allows qualifying farmland to be valued based on its agricultural use. This means that the taxable value can be significantly lower, which can help reduce or even eliminate estate tax liability. To qualify for this special farmland valuation, certain conditions must be met. First, the farmland must make up at least 25% of the total estate value. Additionally, total farm assets, including land and personal property like equipment, must account for at least 50% of the estate. The decedent or a family member must have owned and actively farmed the land for at least 5 of the years before death. Finally, the farmland must pass to a qualified heir, typically a family member who intends to continue farming. When it comes to estate tax exemptions and rates, estates are only subject to federal estate tax if their value exceeds the exemption amount. The tax is marginal, meaning it only applies to the value above the exemption. Rates range from 18% to 40%, depending on the taxable amount. For farmland estates, if the estate's value after deductions and special valuations is below the exemption, no federal estate tax will be due. Effective estate planning is vital for farm families. It can help minimize inheritance tax burdens and ensure the continuation of farm operations. Strategies can include using special valuation rules, making lifetime gifts, and structuring ownership and succession plans to meet qualification requirements. If farmland is sold or taken out of agricultural production within 10 years after the decedent's death, any deferred estate tax under Section 2032A becomes due, sometimes with interest. Another important aspect is the step-up in basis. When farmland is inherited, the cost basis typically steps up to its fair market value at the date of death. This means heirs can potentially reduce capital gains tax if they sell the land later. However, if the special valuation under Section 2032A is used, the basis may be adjusted, which can affect future tax liabilities. In summary, inheritance tax on farmland is governed by specific tax rules designed to support family farms. By valuing farmland based on its agricultural use rather than market value, it can reduce or eliminate estate tax liability, provided certain conditions are met. Effective estate planning is essential to navigate these rules and protect farm assets for future generations.